Thank you all very much for joining us this morning. My name is Steve McMenamin. I'm from the Indian Harbor Group here in town. I'm your host for today's event, which is part of the ongoing series of the Greenwich Roundtable. It gives me great pleasure to welcome back one of our earliest underwriters, Dan Kashav. Dan and Putnam Lavelle are generously underwriting today's session once again. Dan, is there anything you'd like to say to the members?
Sure.
At this point?
First of all, we're honored to be a sponsor of this event and of the Greenwich Roundtable, and are particularly thankful to all the people who make these events and this organization work. Many people are involved, and particularly Steve McMenamin for his hard work in that regard. Putnam Lavelle is known to many of you as an M&A boutique focused on this industry, asset management and alternative asset management. Some of you also have read a report that was published in late 2002 titled Institutional or Institutionalized or Hedge Funds Crazy. We made some points in that paper as to the institutionalization of the hedge fund world and what we believe is going to need to happen, what would need to happen to make the industry institutional. We are also putting our money, our efforts where our words are, and are actively sponsoring events such as this, and making investments in companies which we believe provide services to institutional investors, such as DPM and indirectly in investor analytics, and are sponsoring hedge fund managers and providing them an ability to build institutional quality infrastructures to be successful and to be appealing to institutional investors such as yourselves. And we will do more things like that with the focus of providing value-added services to institutional investors. Part of that is education. Part of that is getting managers and trends in the marketplace in front of institutional investors. And the Greenwich Roundtable Forum is a great place to do so. So we're very honored to be sponsors of this organization.
Thank you, Dan. We believe in education, and we appreciate your support. We'd also like to thank the Bruce Museum for giving us an intimate place to gather this morning. Our topic this morning, What's Up with the Stock Market, is the first real examination of the equity markets we've had here since before the bubble burst. Let me apologize for the irreverent title, but with the opinions so divided between the bulls and the bears, a more serious title doesn't seem to fit. And perhaps today we'll learn why both sides may be right. So as usual, I'd like to ask you to fill out the backsides of the invitation cards. Sakai will not let me come home without them, and so we can learn how to do a better job. Today our panelists are two legendary practitioners, but before we learn their backgrounds, I'd like to introduce you to our moderator today. Joining us from San Francisco, Don Putnam is the moderator of the Greenwich Roundtable. And once again, I get the distinct pleasure of telling a Don Putnam story. One of Don's ancestors, or some of you may know this, if you've seen the police cars in Greenwich with the logo on the side, there is General Israel Putnam on the side of the police cars in Greenwich. Don's ancestor was Israel Putnam, Senior General of the Revolutionary Armies of the United States. On a cold morning in 1779, General Putnam performed a miraculous escape from advancing British troops, sorry Malcolm, on what is now known as Putz Hill, next to the YWCA on Putnam Avenue. Don's great-great-grandfather, went on to the Battle of Bunker Hill, where he was heard saying, "Don't shoot till you see the whites of their eyes." But more to the point, Don is the founder of Putnam Lavelle NBF, a leading investment bank in our industry. And to Dan's point, Putnam Lavelle was the leading advisor to the GAM UBS sale, the Glenwood Mann sale, Tremont Oppenheimer acquisition, and the Momentum Unicredito sale. Putnam Lavelle is consistently at the top of the league tables for asset management M&A. So please welcome Don as he sets the table for us this morning.
Well, good morning. And of course, it's a great... I love to hear that story because, of course, what is obscured is the fact that this was, had we lost the war, this would have been known as an ignominious retreat. After all, General Putnam started in the Battery and ended up in Boston. And that doesn't happen by advancing. Long ignominious retreats. In fact, the longest retreat in U.S. military history up until the Korean War are turned into victories if you win in the end. Now, we're going to hear from a couple of very different perspectives this morning, and I think it's going to be an exciting time. I'll begin with David Einhorn. David is president of Greenlight Capital. It's a long-short, value-oriented money manager founded in *96 with compounded returns of 30% plus a year, growing from $1 million to $2 billion, presumably with a few inflows along the way, since even I can do that math. And but the fund is currently closed to new investors, which allows David time to come and talk to us. He began his career at DLJ as a generalist in investment banking, where he was involved in merchant banking, M&A, and was a member of investment banking teams that provided advice to a number of corporate clients. After DLJ, David joined Siegler, Collery & Co., a buyout and money management firm, as an investment associate, where he performed fundamental research for the purpose of recommending new investments for the firm's proprietary capital. I'm always struck by the fact that we put on websites such extraordinarily dull presentations of our personality, don't we? I'm just going to skip ahead. Yes, no, that's not true. I know better than that. I'm just going to skip ahead to say that David is focused, disciplined, and considered to be one of the brightest lights in the long-short community. I'm going to take the opportunity now also to introduce Jeremy Grantham, who is the chairman of Grantham, Mayo Van Otterloo, a firm he founded in 1977 on the philosophy of value-oriented investing. We all know GMO. It's been around a long time. It's a privately held money manager with over $60 billion in assets under management, has tripled in the last 3 or 4 years, and manages a very wide array of styles and funds with absolute return hedge funds and other alternative investment vehicles. Before starting GMO, Jeremy was co-founder of Batterymarch, which we all remember as really the bellwether manager utilizing quantitative techniques. Jeremy is an innovator, provocative speaker, and known to be early and right, and sometimes very early and very right, which is what makes him gives him such an interesting perspective. I'm going to ask Jeremy, who came prepared with slides, to set the tone. We'll do this in the following format: a few minutes of introduction a few minutes of commentary from Jeremy, and then we'll turn to the rebuttal case, if you will, and then we'll do a little Q&A, including from all of you. So have your questions ready, if you would. Since we have ended in a universe of infinite entropy, all has gone to the mean, and the dispersion of energy throughout the universe is equal. Tell us how we get back to the Big Bang and how we get back to the formation of new universes in a Hoyle sort of way. David?
You're kidding, right?
Believe me, I know it doesn't seem like it, but it's actually worse to go first. You haven't seen Jeremy in rebuttal. It can really it can be much worse.
Well, I can't touch that. They got the wrong guy. I don't have any top-down thoughts for y'all. If I did have any top-down thoughts, suffice it to say, no one's ever gotten a top-down thought out of me. But if I had one, it would probably be kind of bearish, because I kind of think inflation is going up, and no one's had to deal with that since my bar mitzvah. And that might lead to a different perspective on I can go on about the Fed chairman, but that's not really what I came here to talk about. The way I would approach the issue is, since I'm a bottom-up stock picker, that's my job, long and short, and I don't really think too much about the market, and if I did, I probably wouldn't have the results I have, because I'm pretty lousy at thinking about the market as a whole. What I would address, though, that I think might be of broader interest is what I perceive to be large structural inefficiencies that we have in the United States investment management profession and the equity markets and so forth, because these kinds of inefficiencies, although me telling you about them, in case you haven't thought of them, probably doesn't help in the short term or the very long term, they're so large that you can create an enormous opportunity, I think, for guys like myself to do an okay job. The biggest inefficiency that I see is that the big dollars that are out there in professional management today are relative value investing, which means that basically the money is invested against a benchmark. So the operative question for someone who's investing against a benchmark is this security going to outperform a benchmark? And I think that the fundamental basis by which an investment is different than that. I think the best way to go about investing money is say, well, if I'm going to risk capital in this particular asset, does the reward outweigh the risk? And that is a fundamentally different question than will it outperform the benchmark? Because if you're only going to worry about whether it's going to outperform a benchmark, you're going to be happy to lose 20% of your money if your benchmark declines by 30%. In fact, you pat yourself on the back, and you run an advertisement on television telling more people should give you money for this. And the exciting thing for me is that this is how most of the money that is managed out there is managed. So I don't have to do anything that's smart. I just have to make sure that I ask what I think to be the better question, which is, does the reward on this particular investment outweigh the risk? And that's how I go about the business. Second big inefficiency that comes with this is that I think that professional investors, even to the extent they're thinking about the question right, I think they're lazy in the analytical rigor in which they apply the analysis, or they're not capable. I mean, I saw a survey from Merrill Lynch, and Merrill Lynch asked institutional investors, what is the number one metric you use in evaluating whether an equity is attractive or unattractive? And I was shocked and appalled when I read that the number one answer among institutional investors, and they surveyed a few hundred of them, was the so-called PEG ratio. The PEG ratio, in case you don't know, is price earnings multiple compared to growth rate expectation, presumably over 5 years. I first read about it in Peter Lynch's book, which I think was written so that my grandma could invest alongside Peter Lynch without having to pay him the fees or whatnot. And he didn't really go into a lot of stuff about technical valuation, but he basically said, if you discover the next Gap stores, and you want to look something at value, so make sure the growth rate doesn't exceed the PE multiple doesn't exceed the growth rate, because if it does, probably somebody else has already figured out that this is going to be a good company. The problem with the benefit of the PEG ratio, and which is why this is the most widely used metric on Wall Street, is it's very simple. It's very simple. You can calculate it very easy. How fast do I think it's going to grow? 15%. What's the PE multiple? It's 25, so it's a 1 2/3 PEG, and I can therefore benchmark it. Blah, blah, blah. And so it benefits from its simplicity. But that's the only use, I believe, for the PEG ratio, because the proper relationship, I'm not going to get into too much math, between a PE multiple and a growth rate is nonlinear. It's a nonlinear relationship. And the PEG ratio is a linear relationship, which basically means is you have a very sharply accelerating curve, and you're trying to fit a flat line across a curve. And it intersects in about 2 points, as you can picture from your 9th grade math or 10th grade geometry. And in most of the places, there's a very, very wide discrepancy between where the curve is and where the line is. So this causes people, professionals who are using the most commonly used metric in investing, to be using something that's completely nonsensical. Let me give a very simple example. A PEG ratio does not allow you to distinguish between the merits of an investment with a price earnings multiple of 1, where you expect the growth rate over the next 5 years to be 1%, and a company where you expect the growth rate to be 100% for 5 years at a price-earnings ratio of 100. And I will assert to you that a PE of 1 for a company that's not growing is an extraordinary opportunity. You're going to make around 100% annualized on your capital, and you don't have an enormous amount of forecast risk. Whereas a PE ratio of 100 on something you think is going to grow at 100%, you're going to make a 1% return your first year, a 2% return the second year, and you better hope your forecast is right for years 3, 4, and 5. So that's another major inefficiency, that every time we see sell-side analysts or buy-side analysts talk about PEG ratios, we think there's a reasonable possibility that the stock might be misvalued in the market. Another major inefficiency is leverage. People evaluate price-earnings multiples. They don't correct for leverage. In other words, levered earnings are more risky than unlevered earnings. And when people compare companies, they'll often look at companies and say they're both at 15 times earnings, but one is levered and one is not. But they can't seem to recognize that it's much better, much less risky, and in fact statistically cheaper to buy, the unlevered company. So I think the last major inefficiency that we see is investment horizon. And by that I mean most investors, this is the ones that have a long-term view, are willing to buy something or hold something because they're concerned that it's going to do well for them over the next 6 months. Never mind the people who think that they're going to make money on it the same day that they buy it. And equities are long-duration assets. And their duration is much longer than 6 months. And it's very hard to predict what they might do in 6 months, individually or collectively, I think. And, the career risk, I suppose, as he would put it, of owning dead money, I guess a lot of people finds to be too high. I find it very exciting if I can own a portfolio of stocks where most of them aren't going to go up for the next 6 months, but they'll all go up eventually because I think the risk-reward is attractive. Some of them will surprise me, and they'll go up sooner than I think. I won't necessarily know which ones on day one. And if the biggest risk is quote-unquote dead money, that's not such a bad thing, because what kills you in investing are the losers. If you lose money in something, then you have to do something else brilliant just to get yourself back to square one. And I think that investors that avoid stocks because they don't perceive them likely to appreciate in the near to very intermediate term create a lot of opportunity for folks out there who are willing to look at a little bit longer term and hold a portfolio of things. Where does this all go? I think in the long term, I think absolute return investing has to eventually be offered to more people. I think the very large professional money management companies should abandon their relative value investing and their benchmark investing. They should offer mutual fund type products to people with an absolute return basis, and they need to educate properly that in a rising market it's going to underperform by a lot, but that's not what you're here for. And once that happens, big dollars can go into these kinds of strategies. The world can converge. The markets can become more efficient, and frankly the fees for the few guys that are doing absolute return investing, which I guess now is more than a few guys, but it's still small in the scheme of things, will converge and will come down, and we'll wind up with a much more sensible investing climate. And then I'll just be left with trying to outperform the guys that are still using the PEG ratio. Thanks a lot, guys.
Jeremy, why don't you start out with the Distaff case?
Okay, first of all, I want to put you down in your relationship to General Putnam. You have 1,000th of his blood. Yeah. I've worked out it's reasonably likely I have more than that.
Is this a survivorship thing?
That's it. And I wanted to put in a word for your loyal French allies that have been so badly treated recently. Without whom, of course, you'd be in a terrible, terrible shape, something like the Canadians, no doubt. Okay. Last night we got to talking about how brief you could be in describing how the market works. And it's been a hobby of mine forever, and I think the world record was set last night. Our table got it down to 8 words. Okay, this is everything important that we collectively knew about the market. Thank you for your help. Mean reversion. Commentary there is that's the only really important thing I know about the market. Everything goes back to trend. Second, uncertain timing. Unfortunately, we just don't know when it's going to go back to trend. Third, career risk. And if you have uncertain timing, it's not arbitrageable. And there can be wonderful opportunities, but if the timing is uncertain, your job is on the line, your business is on the line. And finally, size matters. The best kept secret of our industry. Every practitioner knows that size is a killer, but the investment management business is the best example of the Peter Principle ever designed. Do well with 500 million and they'll give you 5 billion. Do well with 5 billion and they'll give you enough to make sure that whatever value you could add has gone. Okay, the market. So everything, you've heard everything now. So what is the trend on the market? Trend is easy. Trend line PE is 16. That's hardly debatable. That's the 100-year trend. It started last century at 12. It ended at 16. It trended slightly higher because the world became a safer place. Manufacturing dropped, services rose, GMP became more stable, and the stock market became more stable. And therefore, you should need a lower return to be bribed into buying risky stocks, and that is the way it worked out. So that seems pretty plausible. When you do PEs, you've got to have a normalized earnings base. You can't compare recessions with booms. So that's pretty easy too. What is the normal return on sales? We know that. It's about, to be generous, about 6% on sales. So what we do is we take 6% on sales as a normal earnings base and multiply it by 16, and that gives you trend line market, which is about 720 on the S&P, currently 1120. And that's that. So the market will go back to 720, step one. If it does not, it will be the first time in history. We have been through every asset class for which data exists in machine-readable form. We had one of our guys running around cheering that he'd found Prussian rye from 1685. And we have no trouble, unlike Alan Greenspan, defining what a bubble is. A bubble is a 2 standard deviation event, the kind that would occur randomly every 40 years. That sounds reasonable, I think. And we went through commodities, currencies, stock markets all over the world, all the way down to Kuwait. And we found 27 bubbles. And the most important 12 are on one of the exhibits of this little handout. Oil, gold, 1929, 1965, Japan in 1989, all the obvious candidates. Of these 27, we asked a very simple question since we were betting the firm at the time on mean reversion. How many of the 27 bubbles in the last 100 years went back to trend? And that was pretty easy, 27. So in soccer terminology, it was mean reversion 27, new paradigm nil. Now, intellectually, we all know there can be a new paradigm. So any bull who thinks that it's going to be permanently above 16 PE can entertain this justifiable hope that this time it's different. Never has been different yet, but hey, there's always a first time. So we're going to go back to 720. Every great bubble that has broken, and I don't mean most, I mean every, has overcorrected trend line. The ugly thing about trend lines that we all forget is by definition you spend half your time below. And most of the time spent below the US trend line has been precisely following the breaking of the great bubbles. The great bubble of 1929 breaks by 1932, one of the quicker ones. All of the 30s, all of the 40s, and right through to 1958 is below trend. That's not bad. 1965 is the next peak, breaks by 1974. All of the 70s, and all the way up to early 88, or for a minute or two in 87 is below trend. Japan, probably the greatest bubble in the world, bigger even than the US's recently, has been the last 7 years below its trend and counting and counting and counting. And that is absolutely typical. So we are likely to go below 720, spend several years below the trend line, which grows at about 1.8% real, enough to bore you to death, the trend line. And that's that. So you have to be prepared for a correction below 720 and a period of several years. And any expectation to the contrary is in complete defiance of a huge breadth of historical data over a vast variety of different economies and different asset classes. Now, recently we've spent a lot of time on trying to get a fix on closer timing. And we found that the politics of the economy, the presidential cycle or the Federal Reserve cycle, tells you a lot more on a one-year horizon than value. Value is brilliant over 7 years, very good over 3 or 4, and fairly weak over 1. And that is its great problem. But the presidential Federal Reserve cycle is pretty good over 1 year, about 3 or 4 times better than value or mean reversion. And the presidential cycle is the most easily understood of anything I know about the market. The last 2 years of the cycle, you engineer stimulus, strong economy, a decline in unemployment, which is the thing that drives the vote the most, unemployment or employment numbers. And the first 2 years, you tighten ship in order to create elbow room for years 3 and 4. The numbers are amazing. Since 1932, when Keynes explained basically to FDR all about stimulus, the system has worked like clockwork. The average third year, which is when the heroics go on, is 9 points a year ahead of average. Years 1 and 2 average almost -5 to that. The consequences for the year by year are immense. In the first and second year, every second year is down in real terms. In year 3, no year has ever been down materially. There was 1 year, 47, when everything was going wrong. Popularity of the president was off the bottom of the totem pole. The North Koreans were massing on the border, the Berlin airlift, etc., and it went down 2%. That is the worst that has ever happened in year 3. Value of the market does not matter at all in year 3. You can go in with the most overpriced market in history like 99. It doesn't even pause for reflection. It goes straight up. The return to risk is also exactly what you'd expect. In year 3 and 4, the driver is moral hazard. Basically, throwing money at the battleship GMP is very modestly effective. But when you do that, you create overflow into the financial system, which is hugely effective. So the unintended consequence of trying to drive election numbers is you have a huge move in the stock market. So that's all pretty straightforward. But if you look at the statistics, they're not enough, GMP, productivity, and so on, not enough to explain the market. The bedrock is moral hazard. What they're saying is in year 3 and 4, not only will we try and keep rates low and money available, but trust me, if anything unexpected goes wrong, we will try and bail ourselves out to get re-elected and, inadvertently, of course, bail you out. So if you're listening, speculate now. But in year 1 and 2, suckers, you're on your own. In fact, it's worse than being on your own. We're going to come and tighten the screws. And you see this in the data internal to the market. Growth stocks win big in year 3. Even though they lose overall, they win by 5 points in year 3. Volatility, however, is the biggest. Volatility is about 17 points ahead of the market in year 3 and about 11 points behind the market in year 1. So by year 1, you want to duck. Okay? Year 4 is an interesting year. It's the only normal year. It's normal in every way except volatility. Since 1932, the volatility of year 4 has been half the other 3. Not 83%, half. Instead of 22% plus or minus, it's plus or minus 11. This world is not efficient. This is an amazing disparity. Year 4 is very stable. You coast up to the election, no heroics. Unemployment rises in year 1 and 2, falls in year 3, and drifts to a new cycle low in year 4. Everything is working well. It is amazing and impressive that the politicians have worked out what moves to vote and have engineered some moderate and important success in getting the numbers they need. So, short-term horizon, year 4, big hangover from the stimulus of last year, which was the biggest stimulus in American history. My bet is that this is skating on thin ice, but the ice will hold for the first few months of this year, and our firm has been taking more risk than normal last year and the first quarter. And I still think it should be good for another quarter or 2 or even 3, which would be delicious. We are slicing out month by month, which is what I recommend. We've gone from more risk than normal, big positions in emerging equity, big positions in emerging debt, big positions in small cap international, and even in the individual funds, a higher risk profile than the market on January the 1st. By the end of next month, we will have a normal risk profile in the funds. We're beginning to slice out of the high-risk asset classes. By the end of June, we will be almost where we are normally as a firm, which is moderately more conservative in every fund than the market. And by December, we intend to have battened down the hatches completely, to have as little risk as we can possibly take. The interesting things in the market is quality. Junk last year was perhaps the best return to junk ever recorded. There is no category of junk that did not do well, quite unlike 99, for example, where small cap was trashed. And the consequence is that high-quality stocks are relative to the market, interestingly cheap. Small cap is even better expensive. A long history of loving small cap, but everything has a price and it's expensive. And volatility is expensive. So the numbers are in agreement with the presidential cycle, and value matters reasonably this year, unlike year 3, and value matters enormously in year 1. So we go into year 1 with a horribly overpriced market, with debt coming out of our ears, however you measure it, with an enormous need to tighten the screws, with great amount of moral hazard, probably a world record. And when interest rates start to rise, and when we hit next year, it is what I call the black hole. I think it's the best bet that next year and the year after will be bad of any in my career. In the meantime, broadly based assets are as broadly overpriced as they have ever been in my career. 99 and 2000 is no comparison at all. March of 2000, making money for a client who was reasonably flexible was a piece of cake. Bonds were cheap. TIPS yielded 4.2. Real estate was cheap. REITs peaked at 9.2 yield. Value was cheap. Small was almost as cheap as the Nifty 50 era. Value was the cheapest it's ever been in history. Small cap value rose through the decline. REITs went up 35%. Bonds went through the roof, double digit. TIPS were spectacular. It wasn't difficult at all to actually make real money every year of the decline, which I'm happy to say we did. This time, it will not be easy. And in fact, I expect in accounts that do not allow short positions that we will lose money however hard we try. We've introduced a quality fund. We're going to introduce a real asset fund. We're going to do anything that we can possibly do that's legal to save money starting next year, but I do not believe they can save enough money to actually have a positive return. And the little handout I gave you, for the record, the first page shows you the 4 typical parameters of the S&P 500 since 1925. The top right-hand one is price to replacement cost, called Tobin's Q, and the bottom left is price to a rolling average of 10 years for PE to normalize the earnings. The green dotted lines are the 2 standard deviation events, and the bottom left and the top right are the interesting ones, and you can see how stunningly similar the shape of the red wriggling around the trend line is. You can also see how dramatic on all 4 the top right-hand spike is. If you could not see that right-hand spike, you were not looking at the data. And if you saw it and did nothing, you're chickens. The next one, page 2, is just based on mean reversion and normal profits, We work it through, and we amortize the pain and pleasure over 7 years. That's how we do it. Instead of taking it down tomorrow, we take the PEs down from currently 24 times trailing to 16. We take the profit margins down a little bit to normal, and so on. And these are the numbers we get. On the left, U.S. large cap, minus 2% a year for 7 years, after which you get the normal return of 5.7 real. Okay? If you get the pain over quicker, you get to 5.7 quicker. If it overcorrects, which you probably will, you'll get to 7 real, which will be wonderful. The dark blue international, not bad in comparison, but not good absolutely. Emerging even at 2 brute, overpriced, finally after fabulous performance, up another 10%, 12% this year. Our emerging was up 70.0 last year. And the white bar is what we think we can add. The red series, look at it, poor pathetic fixed income. 2.1, 1.8, even emerging at 4.3, very high risk asset class for that kind of return. Poor old REITs, in March of 2000, our estimate for REITs was 10.5 real, right at the top of the market, 10.5, and now 2.4, although recent days have taken it all the way back to 3.4 or 3.5, which is getting to be interesting. It might even be 4 today. Had a massive decline. Managed timber on the right, my favorite asset class, just simply a mispriced asset if you're not buying timber. It's because it's unfamiliar. The reason timber has a high return is 2 reasons. It's illiquid. Any illiquid asset class, you get paid 1 or 2% a year extra.
You should.
And you should. And it's unfamiliar, and therefore carries career risk. Any unfamiliar asset class, you get 1 or 2% a year, and you should, because your career matters. So there are 2 perfectly plausible reasons why you get 3 or 4% more than is justifiable by the risk and return of the asset class. So timber has beaten the S&P for the last 100 years, has yielded 5% versus the S&P's 1.5. The price series alone has won without yield, and it's negatively correlated in the 4 great breaks of the U.S. equity market, all 4 of them, 1929, the inflationary one of the 70s, and the last one. The price of timber has held, the yield has given you a positive real return when you really, really needed it. And finally, page 4 is the all bubbles break exhibit, which, on the top right-hand one, which is the S&P 500, which is, you have to admit, one of the most beautiful, round, perfect bubbles ever recorded by mortal man. And we end it at the bottom of the market in September 2002. We did that exhibit when the black question marks were 1/3 of the way up the left-hand side of that mountain. So you can imagine month by month, that was kind of an exciting thing to see the question marks rising, rising, rising over the top and down the other side. Since then, they turned around and spiked back to a 1.5 standard deviation overpriced. This is not how bear markets end. Bear markets do not end with a complete easy return to speculation, with a huge recovery in the internet survivors, led by tech stocks and led by growth stocks. Hey, this is not how a great bubble ends. It ends with nothing but talk about fiduciary responsibility and protection of assets and a move to bonds and risk, risk, risk on every side. As you can tell, this is not the environment associated with that kind of... Now, Japan was death and destruction, gloom and doom. The 30s were, the 70s were, and this will be one day. And the last one, page 5, actually is just to make the point that you can know all this, everything I've said, and you can do nothing about it, because it's so profoundly dangerous to your personal careers or your companies that you cannot get up and say, typically, this is a terrible bubble about to break, duck, because the clients don't want to hear it. I was barred from the Ford Foundation because they said I was plausible and therefore dangerous to their large growth stock positions. And we went from 30 billion to 20 billion in the greatest bull market in American history. That is actually difficult to do. The market was trying to take our asset base up all the time, and we were falling. We had 45% of our assets withdrawn for making the right bets for the right reason and winning them. We lowered the risk and increased the return and lost more business than our competitors. It is a dangerous thing to do. If you're a public company, you simply cannot do it. If you're jumpy, you can't do it. And it will be there forever. Career risk will never go away. Benchmark, specialization, market niches, measurement, style drift will never go away. Career risk is rising, not falling. It becomes more dangerous to make these bets. In the old days, you went to the gentleman at Morgan Guarantee and said, here's our money, manage it. If he wanted to buy a few more bonds or a couple of international stocks, he did. And then it split into more and more subdivisions, increasing the risk, lowering the arbitrage mechanism, until the opportunities become bigger and bigger, until we end up finally with colossal opportunities that no one dare take advantage of.
All right. Well, that's going to be a tough act to follow. Well, one of the themes that's come through from both of you is that it's possible to recognize the existence of an arbitrage opportunity, as reflected in either risk reward for investing or in mean reversion, without having a clue as to when it will come true. That makes it sound like the one thing you guys agree on, absolutely, is that in effect you have to invest for a longer term than you'd like, than would be comfortable, and simply stay with the uncertainty of how quickly the reality that you perceive will percolate into the market and actually reward the portfolios. Is it just Pollyannish of me to see this as an area of agreement, or is there some difference of view on this issue as well? When do markets actually reward the real, or when does the reality percolate through to the market?
I think I have it a lot easier than he does, because he's looking for one big convergence of the entire asset
You can call me
class.
Jeremy now, we're friends.
I warned you about that, didn't I? Yep.
I have it easier than Jeremy, because what I do is I buy a whole bunch of these individual situations where I think there are these inefficiencies and so forth, and I don't know usually how long they're going to take, and you know, as patient a guy as I am, it's always longer than I wish, but occasionally it surprises me. But the good news from what I'm trying to do is, because I have a basket of these things and they're very idiosyncratic, I never really know when which one is going to hit. And they're going to hit at different times mostly. And so as a result, you know, if I don't make any big mistakes and lose, it doesn't really matter to me when an individual idea hits, because I have enough of them that if any of them hit, I'm going to do just fine if I don't make mistakes. Whereas Jeremy, you know, has to, I think, wait for the whole market to, it's kind of a single bet, so it's a sort of a less diversified thing. So he's got a higher career risk, as he would put it, on the mean reversion.
Jeremy?
Yeah, well, you can't get blood out of this stone. We don't disagree on anything that he said. First of all, you know, David was making the point about kind of real risk versus benchmark risk. It's one of the central issues in our business. Portfolio Management 101 says all you need to know is the real estimate, the real return, the real risk, the difference between the asset classes. And that's how you build a portfolio. You look for the highest risk-return ratio, called the Sharpe ratio. How much risk per unit of return, and you build the most efficient portfolio that the client's risk tolerance will take. It's absolutely basic, and nobody in round numbers does it. And when we started to do this and offered it as portfolios, the consequence is the portfolio doesn't look like anything you're used to. And we did this 2 years before the market peaked. We offered real absolute return portfolios. And we screamed about it at client conferences, wherever we went, and we had zero takers. Finally, a wealthy individual was kind of teased into doing it because I said, you know, no one had enough hair on their chest. He said, I have enough hair on my chest. Here's 50 mil chomping on a cigar. And we filled up and closed them down to new clients. And why have we had to close them down? Because they use huge pieces of emerging equity, small cap international. We don't have any U.S. equities in that portfolio. It simply doesn't have enough return. So you've got this very strange-looking portfolio with some fixed income and lots of emerging equity and so on and a few REITs. And no one can live with the portfolio that comes out of the optimizer. So you could offer it as much as you like. You basically get no takers except in a market decline. And then in a market decline, you can fill up. And then in the next bull market, they all leave again. So it's hopelessly non-commercial strategy, even though it's exactly the right thing you should do, because it's impossible to educate the clients. One of the reasons is the clients keep changing. You spend years and years brainwashing some of the hired guns on a committee of some college, and then you show up and they're all gone, and there's a bunch of gunslingers from hedge funds, pardon the expression, and we're all in the hedge fund business these days, and you have to start all over again.
I'm going to open up to questions. Go ahead.
Given the magnitude of that reversion, it's likely to have effects on the economy as a whole, on the operating characteristics of underlying companies and economic different periods, particularly for David, but also for Jeremy. To what extent do you have to deal with top-down considerations in selecting specific opportunities that you put in the portfolio? And how does that tie into your overall portfolio construction on an ongoing basis?
I don't think about it very much. Very, very little. It's not that it's unimportant. It's that it's not a factor that I can evaluate and add anything to the discussion. So what I try to do is identify a portfolio of situations where every situation obviously is going to have economic risk and so on and so forth. But I try to find situations that have specific idiosyncratic events or structure or conspiracies or manipulations or fraud or whatnot to participate in, where yes, the economy is going to have an impact on the investment outcome, but whether I get the basic analysis right on the things that I'm focusing on are likely to be the bigger driver of the outcome. And then I make a book of these ideas, some of which are long and some of which are short. And whereas the shorts are not there to hedge the longs, they're there to be profit centers on their own because of the specific problems within these particular securities. Even though I'm not trying to hedge, I get a hedge. Because we have longs and shorts, and if the market goes straight up, the shorts will, absent specific events, will lose money. And if the market goes way down, the longs will lose money and the shorts will benefit. And so I can't really figure this stuff out. And so I just try to focus on places where I think I have a better chance to be ahead of the game.
So you're operating, in a sense, at the tails of relevance of the macroeconomic factors. They just aren't that crucial.
I think that's generally right.
Jeremy?
Now, we're quants, so we program regression at the asset class level, at the sector level, growth versus value, large versus small, which are really important. And then at the country level, Germany versus England, and even at the currency level. And then at industries and stocks, individual stocks. And because there's a lot of specific noise at the stock level, it only works if you have 200 of these stocks with this characteristic versus 200 of those with that characteristic. And you know that in the long run you'll win, but you don't know which companies will do it. There will be exceptions, of course, at the company level. But if you have a large portfolio, it will come through dependably, or it always has done. And so we have regression programmed from top to bottom. And it's probably at least as important at the stock level, having profit margins regress at the right rate in your model as it is at any other level. Our hit rate at the stock level is about the same as it is at the sector level, a little bit lower. And that's almost as good as it is at the asset class level. And it's a little bit lower again. So the highest probability is at the asset class level. They always win. There aren't exceptions. An individual company can cease to exist. or can spiral off and become a Microsoft. But an asset class can't do that. The trouble is, even though the hit rate is higher, because there's so few bets, the risk level with clients is much greater. So you have to be much more careful handling that risk than you do the companies.
Yes.
David, you said, you said that you expected an increasing portion of the long-only world to gravitate towards a long-short style of investing. And Jeremy, you said of your $60 billion that the only way they were really going to be able to protect themselves in 04 and 05 was your inclination to try and move them to a long-short style of investing. Now, assuming that of the world's $50 trillion pool of savings, that say 15 to 20 trillion of that is equity, is there, in either of your estimation, some natural limit as to how much of that money can be long and short? How much money can really go short the equity market before you start to alter the way the markets behave? How much borrow is out there? How much of that money can really earn a return in a long-short style of investing?
I might be looking out many years, too many years, for practical purpose, because I don't see this sort of shift happening anytime soon. I mean, I might not live to see any of this shift. I don't know, but it seems to me that, there's money that's being managed. Well, I will call. There's obviously within a curve. There's good long-only managers, but structurally it's being managed poorly versus structurally well, and hopefully over time people figure out. It doesn't matter to me, but presumably over time people will figure out it's better to manage it well than not. And so to the extent that shorting or whatnot becomes more mainstream, the market's behavior will change. It will be tougher. It will be better. It will be a better market. And if people are going to participate in this in a more widespread fashion, the logistical problems of borrowing shares and so forth, they'll be corrected for one way or another. Right now there's all kinds of rules that limit, for example, short selling, and that's because the powers that be that make the rules want a tilted field in favor of long investing. So there's all kinds of restrictions on short selling, and if over time short selling became the mainstream way to invest, people would loosen up the rules so that people would be able to participate, in the game as desired.
I think the amount of shorting will increase enormously, and that the hedge fund business will grow enormously in the next 10 years. It shows every sign of a bubble superficially, but it has the enormous luck, which I can't think of any other bubble having, and that is that if I'm right, or when I'm right, I prefer, and the market comes down, every hedge fund practically is going to look like a hero. If the market, hits 580 in 3.5 years or 4.5 years, everyone who owns hedge funds will feel enormously reinforced, and the industry will continue on the way down and on the early years of the recovery with enormous growth. That's no problem. It already affects the market. Things trade differently in emerging debt, and that's been the cutting edge of seeing the hedge fund business. But the response to interest rates is accelerating and so on. Points to remember is that it's still a zero-sum game. Investment management does not create a single unit of value. We shuffle the chips in the cosmic poker game from the bad players to the good players, but we don't create any value. Hedge funds don't change that. They just take more off the table in fees. So the end pot decreases the more hedge funds show up. And one has to remember that. And every time they start and make money, someone else is making an equal and offsetting amount of dough, and transaction, friction, and commissions rise. And the clients are paying for all that. And finally, a liquidity crisis. The thing we're really setting ourselves up for with the great growth of hedge funds is the next great liquidity crisis, the next great long-term capital. when one thing almost every hedge fund has in common is their short liquidity. So they own less liquid issues than they're short. And there will be one day a terrible rush for the door together to cover. Perhaps the next one will be a fixed income rush with everyone doing the carry trade. And these, I think, will beat new world records, and we'll see that already the hedge fund business has dramatically changed the game that we're playing.
I would just make two observations. One, back to the question of market structure, and that is there are two other phenomena that might operate across the long horizon that are worth mentioning, and one is that a very large, and this really goes back to something that David said, if you really consider the long-term motivation of most sources of capital, sources of investable capital for us, they are actually, in their way, absolute return-oriented in their objectives rather than relative return-oriented. Relative return orientation is an invention of us quants 20-some-odd years ago, 30 years ago, as a mechanism for achieving absolute returns that would be slightly advantageous versus the actuarial requirement rates of the pension plans, on the presumption of infinite horizon, on the presumption that the pension plan and the corporation lived forever. As we know, because of career risk and other factors, it's turned out that it's become a business of its own. But there are mechanisms, like TIPS, for example, which attempt at the societal and market level to short-circuit this, to disintermediate an intermediated market in the same way that first index funds and then ETFs attempted to short-circuit market exposures. And one legitimate point of view, while expecting several $1 trillion in the next 5 years plus of hedge fund money to be allocated over the 10-year horizon, you can also expect a number far larger than that to be allocated directly or indirectly to these short-circuit mechanisms, which we call, in which basket we include ETFs and TIPS and other issues that essentially solve the problem and take money out of the overall actively managed pool. Second observation, which is also a market structure observation, the proliferation of derivative instruments for the absorption of risk has continued in a way that we all know a great deal about, and we all know that this has happened in our careers, that a derivative was a rare and special and esoteric thing at the start of our careers, and today it is a huge factor in the way you choose to implement a preferred exposure in a portfolio. And I think on the short side, that proliferation has actually been as profound as on the long side. But when we talk about barriers to large short exposure, we tend to talk as if we were looking for short exposure on a single stock. But in many, many cases, short exposure on the index is actually what the client is going to be looking for, and derivative mechanisms for achieving it are more efficient. And some of the barriers David mentioned to short selling per se don't apply, and they particularly don't apply in global markets. So I think we're going to see more. I'm not a big advocate of total return swaps. That market is a very inefficient and expensive market. But somewhere between the OEX put and the total return swap, there's a spectrum of derivative exposure that I think will come into being and become more efficient over the next 10, 15 years to absorb the legitimate need for protection on the downside. In the insurance world, that's become extremely well developed, and it makes one optimistic that new techniques will be developed. Other questions? Yep.
Question for Jeremy. What would be your recommended ideal portfolio on January 1st, 2005?
Wood.
We're a timber company, so I can't own that much.
You're already long.
I can tell you what my portfolio will look like, because I don't have any constraints. Short the S&P, long emerging equity, and small cap international, where I'm interested in the spread of value, which is about as big as it's ever been. Short the S&P, long international blue chips. short junky stocks, long blue chips, where I'm interested in the spread rather than the actual move that either will make. Some short-term cashy looking things, but almost all of it in hedge fund form. Conservative market neutral hedge funds, cash plus, and 10 to 15% in timber, and perhaps 2 or 3, 4% in REITs if they yield a little bit higher than they do today.
Could I follow up? Now, if it wasn't for your own portfolio, if it was for an institutional sized portfolio, what would you recommend to your clients?
Get as close to that as you dare. Fixed income. The Warren Buffett approach. I was thrilled when he said in his last one, not only had he built up vast cash, but he also admitted that he'd been way under pessimistic in March of 2000. And he hurt us a lot, him saying, yeah, it's a little overpriced, big deal. That really kind of cut into our credibility. So I was thrilled that he kind of threw in the towel and said he'd made a bitter error. And he just can't find opportunities, so he builds cash. That's what ordinary people who have billions have to do. Ugly cash, chewing glass, minus 1%. But it's better than, as he said, it's better than the alternatives. Now, I don't think it's better today. I'm in the skating on thin ice cynical group of investors. I think we can squeeze out a little more from emerging and small cap international and maybe even the U.S. For a few more months. But that's just kind of cynical gamesmanship, or if you prefer it, a good defense. A good offense is the best defense. We want to have some money in the war chest so that when we batten down the hatches in December, we can stand the market going up for a while, mocking us, which I'm no doubt it will do.
Jeremy, why are you so anti? I noticed in this portfolio there are no other commodities other than timber. Why not?
We're not experts in commodities. I think their main interest to me and why we're starting a real asset fund, as we sit, is not to play China and so on. It's all very sexy and unpredictable and so on. It's just that for several different reasons, a commodity portfolio can do less badly than the S&P 500. If inflation goes up, it wins. And if growth continues in the Far East, it probably wins. If there's an unexpected surge in Europe and so on, it probably wins. And if the market gets utterly trashed, it probably wins, because we're going to have a quarter of it in gold and things like this. So there are quite a few different environments where it will beat the S&P. But in terms of the commodities per se, it's a complicated, different game. They don't yield enough. There's not intrinsic growth there. Your timing has to be so good. It's not a percentage play for ordinary folk.
I'm going to wrap it up with that and thank both of the panelists for an interesting discussion. But please, there is 5 minutes of housekeeping, and I'm going to turn it back to our chairman.
Thank you. Thank you, Don. We have two terrific athletes here today, if we can use that metaphor, and it's not just me that gets them; it's you. I think if you've ever seen our letter that goes out to these fellows, it says, and this is the bait we use, the members of the Roundtable control collectively $1 trillion in assets under management, and thanks to Bill Raver and Bob Hunkler and some of our newer members, we get up and above that mark. But again, I want to acknowledge Steve Bruce for reacquainting us with David, and I want to thank Hunt Taylor for coming up with the title of today's topic. At the same time, I'd like to thank Don Putnam for reacquainting us with Jeremy, who we heard so very bearishly in 1999 that the equity markets would come tumbling down, much to everybody's disbelief. And with that, next month we will continue with our defensive themes at the Roundtable with a look at credit strategies on May 20th. And with that, thank you all for coming, and let's thank our speakers.